If you've spent even 5 minutes looking at Forex content online, you've heard the word pip. I made 50 pips today. The market moved 200 pips in an hour. I only risked 20 pips on that trade. But nobody ever stops to explain what a pip actually is. At least not in a way that makes sense to a beginner. So that's exactly what we're doing today. By the end of this video, you'll know what a pip is, how to calculate pip value, and why it matters so much to every single trade you'll ever place. Let's go. The word pip stands for percentage in point, or sometimes price interest point. Don't worry too much about what it stands for. What matters is what it means. A pip is the smallest standard unit of price movement in a currency pair. For most currency pairs, like the euro versus the US dollar, the British pound versus the US dollar, or the euro versus the British pound, a pip is the movement of 1 unit in the 4th decimal place. Let's make that concrete. Say the euro versus the US dollar is currently priced at 1.1050. If the price moves up to 1.1051, that 1 unit change in the 4th decimal place is 1 pip. If it moves from 1.1050 to 1.1080, that's a movement of 30 pips. Simple enough, right? Now here's where it gets slightly more interesting. You'll often see Forex prices quoted to 5 decimal places like 1.10505. That 5th decimal place is called a pipette, or a fractional pip. It's 1/10 of a pip, and it just allows brokers to give you a more precise price. So when you see a 5 decimal price, the pip is still the 4th decimal place. The 5th is just extra precision. Now, there is one important exception you need to know about, and that's currency pairs involving the Japanese yen. For yen pairs, like the US dollar versus the yen, or the euro versus the yen, the pip is the movement of 1 unit in the 2nd decimal place, not the 4th. So if the US dollar versus the yen moves from 145.50 to 145.51, that's 1 pip. Why the difference? It comes down to the relative value of the yen. 1 yen is worth much less than $1 or 1 euro. So the pricing structure is different. The rule is simple. Most pairs, pip is the 4th decimal place. Yen pairs, pip is the 2nd decimal place. Burn that into your memory and you're good. Here's the key question. If a pip is such a tiny movement, why does anyone care? 1 pip on its own, for a small trade, might only be worth a few cents. But Forex traders rarely trade tiny amounts. They trade in standardized sizes called lots, and the lot size you trade determines exactly how much each pip is worth in real money. There are 3 standard lot sizes you'll encounter. A standard lot is 100,000 units, worth around $10 per pip. A mini lot is 10,000 units, worth around $1 per pip. A micro lot is 1,000 units, worth around 10 cents per pip. So let's put that in perspective. Say you open a trade on the euro versus the US dollar with a standard lot, and the price moves 50 pips in your favor. 50 pips times $10 per pip equals $500 profit. Now flip that. If the market moved 50 pips against you on that same trade, that's a $500 loss. Suddenly those tiny decimal movements look a lot more significant, don't they? This is why understanding pips is so fundamental. Every time you plan a trade, you need to know, how many pips am I risking, and what is each pip worth in my account currency? Let's walk through how pip value is actually calculated. Don't worry, it's straightforward. The formula is pip value equals 1 pip divided by the exchange rate, multiplied by lot size. Let's use a real example. Say you're trading the euro versus the US dollar at a price of 1.1050 with a standard lot of 100,000 units. 1 pip equals 0.0001. So, pip value equals 0.0001 divided by 1.1050 times 100,000. Pip value equals 0.00009049 times 100,000. Pip value equals approximately $9.05 per pip. Now, the good news is you almost never need to do this calculation manually. Every broker platform and most Forex websites have a pip calculator built in. You just enter the pair, lot size, and your account currency, and it tells you instantly. But understanding why the calculation works the way it does gives you a massive advantage, because you'll always be able to sense check whether a trade makes sense before you enter it. This is probably the most important part of this video, and it's something many beginners overlook entirely. Pips are the language of risk management in Forex. When professional traders decide how much to risk on a trade, they don't think in pounds or dollars first, they think in pips. Here's what that looks like in practice. A trader might say, I'm going to set my stop loss at 30 pips below my entry. A stop loss is an automatic instruction that closes your trade if the price moves against you by a certain amount, protecting you from losing more than you planned. So if you're trading the euro versus the US dollar with a mini lot, and your stop loss is 30 pips, 30 pips times $1 per pip equals $30 maximum loss on that trade. Now you know your risk before you even enter. That's powerful. Compare that to a beginner who just opens a trade with no stop loss, no pip calculation, and no idea how much they could lose. When the market moves against them, they panic, hold on hoping it reverses, and end up losing far more than they intended. Pips give you precision, and precision gives you control. We'll go much deeper into risk management in a dedicated video later in this series, but start thinking about pips not just as price movements, but as your unit of risk. Let's recap everything we covered today. A pip is the smallest standard unit of price movement in Forex. For most pairs, it's the fourth decimal place, for example, 1.1050 to 1.1051. For yen pairs, it's the second decimal place, for example, 145.50 to 145.51. The fifth decimal place is called a pipette, just extra precision. Pip value depends on lot size. Standard lot is around $10 per pip, mini lot around $1 per pip, micro lot around 10 cents per pip. Use a pip calculator on your broker platform to get exact values. Pips are the foundation of risk management. Always know your pip risk before entering a trade. Now you know what a pip is, and more importantly, you understand why it matters. In the next video, we're going to talk about lot sizes in detail, what they are, how to choose the right one, and how lot size connects to your account balance and risk. It builds directly on what we covered today, so make sure you're subscribed so you don't miss it. If this video helped you, leave a like. It takes 2 seconds, and it genuinely helps more beginners find this content. And drop a comment below what confused you most about pips before watching this. I'd love to know, and it helps me make better videos for you. See you in the next lesson.